The US market always outperforms. That's what you'll find all across YouTube, all across Reddit, and all over the internet when it comes to investing. The S&P 500 is the only place to be. The UK is uninvestable, Europe is uninvestable. All you have to do is put your money into a US tracker, wait, and you'll be rich. Now, that has been the case, I must admit, for the last 10 or 15 years or so, but that's not always the case. And in fact, there's been decades where the US market has gone sideways and down. And what we're going to cover off in today's video is exactly that. The last 10 or 15 years has been incredible for the US equity market, but we're now reaching a point where pretty much everyone is all in US stocks. And in this recent drawdown, for example, since the start of 2025 with what Trump's been doing, you'll see online there's been a lot of panic and a lot of stress over what seems to be quite a small drawdown. So, you know, the US market maybe is getting a bit toppy, and some people may benefit from diversifying their investments. And what we're going to do in today's video is really break that down. So in terms of the video, I'm going to start with an analogy I quite like, using a ketchup bottle. And then I'm going to come on to a recent example in history, so the early 2000s, of when the US market did underperform and did stay sideways for quite a long time before many of the people in the online space would have even started investing. And then I'm going to come on to talk about the more recent performance, so the last 15 years or so, specifically the last 5 or so since COVID, where the markets have really gone pretty crazy, break that down and see exactly how those dynamics might play out moving forward. Before we get into the video, I want to remind everyone that this is not financial advice. This video is for education and entertainment purposes only. So with that said, let's move on to the core of the video. So let's start off then with the ketchup bottle analogy, which I first came across from a big UK investor called Terry Smith, who runs a very successful fund company called Fundsmith. And what he uses a ketchup bottle to illustrate is how stock market returns typically work. You can think of the ketchup bottle full of ketchup as the returns that an investor will receive. And sometimes when you go to pour out a ketchup from a ketchup bottle, you get all of it at once. Sometimes it comes out in a nice sort of even stream. And sometimes you get a little bit at the start and then you keep shaking it and shaking it and shaking it. And this looks quite inappropriate, but I'm going to keep going. And then eventually the ketchup all falls out at once. And that is kind of, in a roundabout way, how you can think about stocks, especially at an index level. So let's take the US S&P 500, for example. The long-term return, annualized return for the S&P 500 is about 10% a year. So let's say, and this isn't exact numbers because of the way compounding works, but let's say over a 10-year period, you can expect to get a 100% return, 10% per year. Over 10 years, you get 100% of return. Now, you invest at an awful time of the markets. So you invest at the top, and then markets fall by 50%. But over the 10-year period, you're going to get your 100% return. So what happens is, the ketchup bottle, in this analogy, the ketchup's gone into the bottle from the plate. And now this has gone really weird, but I'm going to stick with it. So now what that means is, over the next 9 years, you're expected to get 150% of returns. Again, it doesn't exactly work that way due to compounding, but for this simple example, that's how it works. Or you could get what's happened in the last 10 or 15 years or so, where you've had a ton of performance from the US market and it's just completely destroyed everything else. I think the annualized return for the S&P 500 for the last 10 or so years has been 14, 15, maybe even 16%. So in that example, you've used up all your ketchup, or this is not a prediction of markets, but it can happen, and this could be the reality. You've used up all your ketchup at once, and now you've got your plate full of ketchup and an empty bottle. And the question is, do you want to hold that for the next 10, 15 years, or do you want to reassess your options? And the same almost works in reverse for places like the UK, places like Europe, where returns have either been quite steady, as in nothing out crazy like the US has had, or they've been sideways, or they've even been negative. So the UK, since sort of the financial crisis, has pretty much just treaded water. It had an awful time with banks being quite highly weighted in that sector, having very little tech, also being involved in oil and gas, which hasn't seen much growth in recent years. So in that example, maybe the ketchup bottle's broken. That's one option. Or the ketchup bottle isn't broken and there's just a lot of ketchup yet to fall out. So that was a long explanation, but hopefully it paints the picture of how you can think about stock market indexes differently to how people are portraying them online. So yeah, if you were to believe Reddit, for example, you would think that the European ketchup bottle was broken, the UK ketchup bottle was broken, and the American ketchup bottle was the best bottle ever, because it just outpours ketchup forever, it doesn't run out, and it's got way more ketchup than everyone else. I don't know how many times I've said ketchup in this video, but it's quite a lot, and I'm going to stop now and move on. So hopefully that helped. If not, then you've just wasted 3 or 4 minutes of your life listening to someone talk about ketchup. So coming then on to the recent 15 or so years. Let's say the ketchup bottle isn't broken. Final thing I'm going to say on ketchup. Maybe the ketchup bottle isn't broken. In the US, the returns have been outrageous because the earnings have been outrageous. So there's a number of reasons for this. Again, tech exploding has been a valid reason. You've had social media, you've had even iPhones, for example, over the last 15 years, 2010, they weren't that big. So the underlying earnings have been a big driver. AI recently with Nvidia. But you've also had a number of external factors that maybe aren't as predictable going forward. So for example, you had zero interest rates from about 2010 to 2020. Again, not to try and get too technical, but just think about it logically. If you've got interest rates that are super low, firstly, investors can borrow cheaply and buy stocks up. Secondly, companies can borrow cheaply and buy back their stocks, which drives up the share price. And thirdly, companies can borrow and then invest that money to grow at a cheap price. Going forward, it would be reasonable to expect that interest rates don't go back down to zero and borrowing costs stay higher, and therefore tech and growthy companies should not underperform, but perform more poorly than they have done for the last 10-15 years. Also, you've got the argument that that growth can only happen once. I'm not going to mention ketchup again, but think about iPhones. There's only one, I mean, it's not quite the same because you can replace your iPhones and stuff like that, but that revolution really sort of only happens once. And the question is, can that juice still be squeezed from that market when tech is 35%, 40% of the index, when it was sort of 10-ish or less percent to start off the 2010s? So that's that. And again, if we look at the other indexes in the world, focusing on UK and Europe, for example, the structural headwinds that have been in place for the last 10 or so years are now sort of becoming tailwinds. So that rate story massively helps banks, which are weighted quite highly in the UK index. You've got the German government passing huge government stimulus on defence spending, where, again, we've been in an era of peace for the last 10 or so years. Defence companies haven't had much to get excited about, and now you've got governments, the Russia-Ukraine war, all this stuff going on, and they are pumping money into defence, and that is a real opportunity for these companies to grow their earnings. So you've almost had this sort of complete flip in the wider market environment that should lend itself more to at least a more even playing field, if not a skew in the favour of the indexes that have been relatively forgotten by investors and you won't see mentioned anywhere else pretty much on the internet. And just to finally drive home that point, I wanted to touch on what's called the lost decade in the US equity market. Now, there was one in the 1900s, the late 1900s, so well, there was actually two. The first was in the Great Depression era of the 1929 to around 1940, where markets first fell 90% and then didn't really recover for 15 or so years. You then had the stagflationary environment of the 70s and 80s, where, again, markets went pretty much sideways for 10-15 years. But the one that's most recent, obviously, and the most relevant is the lost decade of the early 2000s. So between 1999 and about 2001, the US market boomed from an internet tech bubble, effectively, and that left valuations incredibly high. And there's two ways that you can deal with valuations that are too high. First is earnings grow into them, and I'm going to do a separate video on this, or you can find it online if you want to dive into it more. You can either grow into your valuation, or the valuation can come down. What happened in the 2000s was the valuation came down, which means stocks come down, which means no performance for investors. So from around 2001 to around 2012, so over 10 years, the US market was flat. Europe outperformed, UK outperformed, and probably if you spoke to an investor in the late 2000s, they'd have said, why the hell are you investing in the US? The UK's got a load of banks, they're really exciting. And the question is, what does that sort of remind you of? Are we reaching the point where the ketchup bottle is empty and maybe it's time to look at other bottles. That's all I'm going to say. And those of you that have been following along my ISA investment portfolio series, you'll know that I have about 65% of my money in the US, but none of it is in the tracker. None of it is in the index. It's all in actively managed solutions, and it's all in specific areas of the market. I don't buy the market more generally. I also have quite a decent exposure to the UK, and through global funds, the rest of the world. And that may or may not be right. You know, in 10 years' time, the US could have continued to completely outperform, and I'll look, well, I don't think I'd look silly, because the economic grounding still stands. But, you know, these people on Reddit and YouTube might be right. But what I would be wary of is when I used to work at Tesco, right? And when the shop floor workers is telling you about the S&P 500 tracker, and you go online and people who have never spent 15 minutes looking at finance are being told to go all in the S&P 500 on Reddit and YouTube, it might be a sign that maybe things have gone slightly too far. But I'm just questioning whether or not now is the time to be as heavily weighted as some people are, especially with the currency movements. So yeah, again, since the start of the year, 2025, the US dollar has been down significantly. If you're in the US, that doesn't matter. But if you're in the UK, what that means is even if the stocks go up, your investments go down because what they're denominated in has lost value. So it's all these different things that come together, and for me, encourage, or at least suggest that you should consider other options. And that's what this whole channel is about. If you watch my other videos, you'll see deep dives on various different investment ideas, different areas of the market. So hopefully I can be a resource going forward if the world plays out how I think it might. So that's that. Thank you for watching this video. If you enjoyed it, please leave a like and subscribe, and I'll see you in the next one.